it's interesting in the fact that you said you study history, right? I'm also a big proponent of looking at history and what history's done. We don't have this scenario ever, right? We don't have the scenario where 90% of Americans have an interest rate below 5%. We don't have a scenario where inventory is sitting at, close to all-time lows. And, what is the solution, right? I mean, the solution is more property, right? More property will allow prices to come down, to moderate, give people an opportunity. It will create, housing affordability, and if those measures would change. But the reality is they can't build homes fast enough to make up for the lack of supply that we actually have. So that said, I think we're in a period of just stagnation to some extent, where prices move up a little bit, they move down a little bit. I'm a big believer that you're not going to see a crash in prices, but I don't think you're going to see a big run up in prices either, right? I mean, we've got this trend going back historically about 65 years of annual appreciation around 4.6%. Right. So what happens is, over a 2-year period, you increase 35, 40, 50% in some markets, you get way above that trend line. So in order to get back to that trend line doesn't mean you have to drop 25, 40% at a time. But I think what has to happen is you've got to have slower growth in that trend, if you will, to get, back to the norm, which in turn allows us to continue kind of going on that upcycle. I do believe personally that real estate will continue to appreciate over our lifetime. I don't think, just because you look at a property today and it's $1 million. I mean, people say, well, there's no way it can be $1.5 million. I say, no, absolutely. It can be $1.5 million. I mean, my wife and I had this conversation. We bought our house for $500,000 back in 2012. And at the time, the joke was, hey, one day this thing's gonna be worth $1 million. Now it's worth like 1.4, and we're going, one day this thing's gonna be $2 million, and it's not going to probably happen in the same way that the last 10 years happened, but it will happen. So for the foreseeable future, though, I'm just one of those people. It's like, hey, buy when it's the right time in your life, right? Don't try to pick tops and bottoms in markets, and just have a longer term time horizon, right? We know what real estate does long term, creates generational wealth. Reason that homeowners have a 44 times greater net worth than those of renters, and 65% of that is tied up into real estate at retirement. So I'm a firm believer that is the right answer for most people, but it's not always the right time to buy a house. You said all realtors are like, it's always right now is not the best time to buy a house, but if it's the right time in your life and everything else is in place, I'm not one of those people saying, well, you shouldn't buy because this is, there's going to be a better opportunity. I don't know that there's going to be a better opportunity, right? I also don't know that there's not going to be a worse opportunity to buy, right? It's a lot of it depends on the, rates and where inventory goes.
Yeah, I think you said a lot of really good stuff to unpack there. And it's kind of like one thing I'll hone in on is where you said the Fed is always looking at lagging data and lagging indicators. It just seems like, all the people that can make the decisions, they're not looking at the proper data. And it almost seems intentional. Like I know in one of your YouTubes, and just so you all know, Jeb's got a killer YouTube channel. You all need to check it out. It's very good. If you like my content on my YouTube, you'll love his. It's right along the same topic. But, you were talking about, just the unemployment numbers and what the Fed's doing to try to knock the back down of the working, just the employment numbers. I mean, that's what's holding this economy up right now. Some say we're in a recession. Technically we are. Others say we're not. The only thing in the three-legged stool that keeps this thing moving is employment numbers. So of course the Fed's going to try to knock that down. And when people obviously lose jobs or get laid off or go on unemployment, they don't have the disposable income. Right now, you can clearly see what's happening. You can see that savings rates during the pandemic were skyrocketing, and debt amounts were being paid down at unbelievable rates. I still look back at that data and I can't believe how fast debts were coming down. But as soon as the world opened back up, or this country opened back up, it was just a flip. Everybody went on revenge summer, spent all their savings. The credit card debts, I mean, what are we at? 17 trillion right now in consumer debt, something like that, might even be higher. All-time records in consumer debt. So we're trending the wrong way there. If we lose employment, that is going to be the one thing that's going to be interesting. And then you mentioned, just there's really no other period of time that we can look at that mimics what this is. And you're right. We literally have to go to several other periods of time, seam them together, and then just make up what we think it's going to be. But the scariest thing for me is, I think you're right about this stag. The price is just being sideways for a while. And some would say that's stagflation. And we are staring down the barrel of stagflation. And listen, folks, like, I can say, like, I'm not scared of a lot of things. I'm scared to death of stagflation. If we couldn't have learned from Japan, when Japan kept interest rates down too long, and then the lost decade after that, the stagflation, like, that's what we're looking at right now. And I hope to God we don't see it, but if some changes don't happen, we're going to. But let's just kind of take that same conversation. We were talking primarily about home ownership for families like you, me, our families. There's never really a bad time to buy your home and to bed down and get it. If prices are high, oh well. If prices are low, bonus. Like, you bought, when prices were low, but back then it didn't seem like prices were low. No. You thought prices were high back then, and look at that, almost $1 million in appreciation. So it's all relative. Interest rates are high right now, but you could always refinance when we go back down. And just so you all know, I'll be the first to break the news if you haven't heard this. Interest rates are going to go back down. We're going to stay at these heightened levels for a little while. And then when we are in a recession, when the Fed gets their way, then the Fed will drop interest rates again. It's just historically what they do. And then you can refinance and do all that, pull your equity out, because I don't think you're going to lose a lot of the equity. So that's a unique proposition right now. If you buy a house now, you're probably going to maintain some of that equity. And then when rates go back down, you can refinance at the lower rate, cash out, pull the equity out, send that money to work. But unfortunately, the people that are going to, I think, really get beat up in this are the real estate investors that just can't see what's coming. And there's a lot of them, because we've been in the longest bull run in history. So a lot of these younger real estate investors, whether they're flipping or buying apartment buildings or doing BRRRRs or sub-twos, or you name the strategy, all of them think that everything's just going to continue to go up. They've never seen the downside of the market, because really, if you think about it, they would have been, I don't know, Jeb, how old would they have been? In their they would have been teenagers about the time when we realized what the other side of this monster looks like. And I know there's a lot of people still flipping houses. And when this thing flips, that's going to be a scary thing for them. So what is your take on real estate investors, not just homeowners, but real estate investors really going out there, pushing forward, scaling, and thinking that this is going to continue?
Well, here's the thing. I mean, buying an investment to flip and that sort of thing is all about the price in which you buy it, right? So I as an investor, I wouldn't shy away from buying investment property personally, but it's all about the number in which you buy it. The profit's made at where you buy the property, not where you sell it. Right. If you're thinking, hey, I've got to do this, and this to maximize my profit, you did it wrong. If you can buy it at the right price, it doesn't really matter what you do to the property. In theory, that value was created in that initial conversation, right? Or initial negotiation with the seller, or however you acquired the property. That said, that's not how most investors buy property in this market. Most investors aren't privy to, hey, buying at the right price. It's, hey, if I can get it here and I can do all of these additional things and the market works out in my favor and I can represent the buyer and all of these things, then I can maximize, a small profit. That's not the right mentality. And I think there's a lot of, like you said, there's a lot of people out there following different strategies, people that are really good at what they do, marketing first, side of things. They're great marketers. And don't get me wrong, they're really good at what they do, but they're marketing to a younger generation to sell courses, to do different things, not pointing to anybody specifically, but those people are the ones that get burned. It's the people that truly don't understand real estate. They just got in it because they wanted to make money, and they don't understand the proposition. They don't understand the market. They don't understand how to negotiate. They don't understand that there's several different ways out of, to create value in these, opportunities and different things in each one of these properties. Those are the people that get screwed. So will there be people? Absolutely. Hell, I sold a property. I'm trying to think. It was earlier this year. It was a guy who, if you got time for a story, really quick story, he wanted a cash offer for his property. I went into the deal and I said, hey, bud, you don't need a cash offer. I can sell this on the open market. Yeah, there's some deferred maintenance, but I can get you more money by selling it on the market than I can off the market. He said, no, I want a cash offer. Okay. I said, I'll try to go get you a cash offer. I wasn't willing to pay the price that he wanted for that property. It was too high for repair, aftermarket value, whatever, right? For ARV, if you will. And so I shopped around 3-4 different people, went to one of my prime guys. He was in escrow. After getting into it, he was like, dude, the numbers just don't work. Like, I hate to do this, but I'm out. Like, I got to back out. And I was like, I get it. Right. So it took me a while. Finally found a guy that was willing to pay more than I had initially had my original guy in at. And I'm thinking, I don't know how this guy's going to make money. He bought it, paid cash, did his thing. And here we are. I don't know, 3-4 months later. I haven't seen what that project looks like, but I got to think the market has flattened since then, flattened in the sense that homes really haven't appreciated, but they really haven't gone down either. So his number was probably the number that I was thinking back then. So I don't know what he could have done to that property to in order to come out ahead based on what we thought it was going to be to fix it up. So those types of scenarios, maybe he got out, or maybe he gets out and not loses any money, but at the same time, he's probably not making much either. And so I don't think the risk is there. I think there's too much risk there. The leverage is too high. And I think that what we're talking about right there continues for some time. There will always be opportunities in every market, but the people that we're talking about here, or that I think we're talking about, are the ones that are going to get, people are going to get hurt. It's just, same people that are not paying their student loans right now and are using that disposable income or that additional income to go do other things. Those people are going to have their life is going to change here really soon when those student loans start to come back into fruition, right? And they have to start paying them.
Couldn't agree more on that. And I think that's the majority of them. They've gotten so used to not paying their college debts and anything that was deferred that they literally don't think they're ever going to have to. So that money that they had that used to be allocated for that is now transitioned somewhere else. And a lot of that money is they can't just pull it back out. So when this all turns around and they have to start paying all these debts, which is, well, for some of them already happening, they're going to find themselves in a tough place. I hope they don't lose their job, get laid off, or do what I think is going to happen to so many people. I hope that doesn't hit them that hard, but it's going to hit everybody hard. But we're definitely going to go into a slowdown. There's no question about that. And it's going to hit all aspects of just about everything, from the stock market to real estate, and it might not even be that it so much affects price in real estate because of the demand, but it's certainly going to impact people when they're trying to get their number for their house and it just sits on the market. They might have to start coming off of that, because the way I always look at it is I'm like, it's supply and demand. Yes, there's not enough inventory, so that's maintaining price. But eventually, we're going to have to come off of these prices if we don't change, what's going on in interest rates, and if people start losing their jobs. Builders are all over this. Builder sentiment's way up. They like you said, they can't build enough houses, and there's no inventory, so folks are having to go to new builds and do that route. So it's going to be really interesting. But all of that looks very similar to 2006 and 2007, because the exact same thing was going on there, but there wasn't the shortages. So that's going to just have to play out. You can never time the market, folks, but you can certainly prepare for it a little bit better than a lot of people are right now. So, just pull back on the reins a little bit, stop spending so much money, stop racking those credit cards up, playing and extending this revenge summer, thinking that you got to get revenge for the couple of years we couldn't go out and do anything. I live in New York. You guys are in California. It was lockdown central. So a lot of folks are just out there trying to live life. I get it. But at what cost in the future is that going to come with?